Hi, I'm Doug Carroll. Welcome to the module on U.S. Treasury and Government Agency Securities. Before beginning a substantive discussion of our subject matter, a brief overview of what's going to be covered over the course of this presentation. The bulk of the session will be devoted to the U.S. Treasury Securities market, the largest, most liquid securities market in the world. We'll begin with an overview of the general investment characteristics of U.S. Treasuries, which cause them to be among the most highly demanded fixed income investments for investors around the globe. To get a better sense of the broader context, the presentation will address U.S. government debt generally, though the focus will ultimately be on the securities that are traded in the markets. So there will be a detailed discussion of all the types of Treasury securities that are traded by investors, bills, notes, and bonds, both the regular securities as well as those with special features, such as inflation protection or adjustable coupons. The Treasury Securities portion of the presentation will wrap up with a discussion of yield auctions, the process through which Treasury securities are issued to investors. The last segment of the module will introduce U.S. government agency securities. First, a brief discussion of this market segment and the general investment characteristics of these securities. That will be followed by an overview of the two broad categories of issuers, agencies and government-sponsored enterprises, and the potential significance of that distinction. The session will close with an overview of the types of securities issued by those entities. Let's begin our exploration of the U.S. Treasury market by identifying the investment characteristics that cause U.S. Treasuries to be among the most highly regarded securities by fixed income investors around the world. The two primary factors that draw investor interest: safety and liquidity. There are several reasons why U.S. Treasuries are perceived as the safest securities an investor could hold when viewed from a default risk perspective. The securities are backed by the full faith and credit of the U.S. government, whose fiscal support rests upon the most valuable tax base of any government worldwide, the U.S. economy. Depending upon how it's measured, the U.S. economy is either the first or second largest economy in the world and has by far the highest GDP per capita of all large countries. Among the large developed countries, the U.S. has the most dynamic and fastest growing economy. The strength of that fiscal foundation is probably the reason most investors view the U.S. government as the most creditworthy borrower around. In addition to that strong tax base from which to raise revenues, another factor contributing to the perceived safety of treasuries is the U.S. monetary system. The U.S. has an independent monetary system. Countries that belong to a currency union, such as the Eurozone countries, have no control over their money supply. In a monetary union, increases and decreases in the money supply are outside of the government's control. Such decisions are in the hands of an independent multilateral institution. In the Eurozone, for example, the ECB, the European Central Bank, controls the money supply. This all might sound somewhat arcane, but is extremely significant when assessing national government creditworthiness. Countries with an independent monetary system can effectively create money to retire debt if need be. The policy of quantitative easing, QE, by the U.S. Federal Reserve is a recent example of money creation. The Fed created money out of thin air that allowed it to buy nearly all of the net debt issuance by the U.S. Treasury in its 2014 fiscal year. Similar policies have been pursued by the central banks of Japan and the U.K., for instance. Money creation raises numerous issues related to economic theory and policy, but those are issues beyond the scope of this introduction to the U.S. Treasury market. The key takeaway is that countries with an independent monetary system never have to default on debt issued in the domestic currency. The liquidity of these securities results from the fact that the U.S. Treasury market is both the largest and most actively traded securities market worldwide, as well as the importance of the U.S. dollar to the global economy. By value of the securities outstanding, the U.S. Treasury market is 3 to 4 times larger than the next biggest government bond market, and it has by far the highest volume of trading of any fixed income market segment. Saying the market is liquid because it has the highest trading volume sounds like circular reasoning, but that accurately captures the reality of financial markets. Liquidity, or for that matter illiquidity, feeds on itself. The more liquid a market is, the more trading volume it will attract, as market participants realize large trading volume indicates a relative ease of entering or especially exiting positions, even if one is trading in size. And given the perceived safety of U.S. Treasuries, most market participants believe that there is always likely ready buyers to be found if they need to sell securities to raise capital, even in the depths of a financial panic. Additionally, the importance of the U.S. dollar in international finance and the dollar's role as a reserve currency contributes to the willingness of investors around the world to invest in U.S. Treasury securities. Many international transactions are conducted in dollars, even when neither the buyer or seller is domiciled in the U.S. Approximately 2/3 of central bank currency reserves are held in dollar-denominated assets, mostly U.S. Treasury securities. Aside from their safety and liquidity, there are a number of other reasons for the strong demand for U.S. Treasuries. Treasuries are very inexpensive to trade. The bid-ask spreads are extremely narrow. Also, the U.S. Treasury market benefits from light regulation. This not only contributes to low trading costs, it also permits a variety of trading and risk management strategies that are either difficult to execute or restricted by regulation in many market segments. Short selling, for instance. An additional draw for investors is that there is something for everyone. There is such a wide range of maturities and a variety of securities having different investment characteristics that the vast majority of fixed income investors can find something in the U.S. Treasury market that might help in the pursuit of their investment or risk management strategies. Regarding maturities, there are maturities at issuance that range from 1 month to 30 years. And since there are weekly auctions of U.S. Treasury bills, one can find instruments that mature anywhere between a few days to almost 30 years at any time. Investors can select from a universe of securities having a variety of different features. There are both fixed and floating coupon instruments. There are the equivalent of zero coupon securities for investors that want to avoid reinvestment risk. There are inflation index securities to allow investors to hedge against unanticipated increases in inflation rates. All the different types of securities having those features will be addressed over the course of this presentation. We'll start with the basic types the Treasury has been issuing for generations: Treasury Bills, Treasury Notes, and Treasury Bonds. Then we'll turn to several more recent additions to the menu of Treasury offerings: Treasury Inflation Protected Securities, referred to as TIPS, and Floating Rate Notes, the most recent issue added to the Treasury lineup, issued for the first time only in 2014. The final type discussed will be Treasury Strips, which are the effective equivalent of zero coupon bonds, although they are not issued by the U.S. Treasury in that form. Strips are created by investors who buy coupon bonds or notes and then strip them. In other words, sell the cash flows separately. This module is part of a fixed income markets program. Consequently, the focus is not on U.S. government debt in general, but specifically on the tradable, or what's known as the marketable U.S. Treasury securities, the ones that are traded in the fixed income markets. Aside from the marketable Treasury securities, there are also non-marketable U.S. Treasury securities. As you might imagine by the name, these are securities that cannot be sold to other investors. They're not marketable. If a holder of a non-marketable security wants to sell prior to maturity, they can only be sold back to the U.S. government. Another way of referring to marketable securities would be to describe them as negotiable securities. A negotiable security is an investment which the holder has the right to negotiate the transfer of ownership, in other words, the right to sell the security to another investor. The phrase negotiable security does not imply anything about the right to negotiate the terms of the contract. The terms of the security are fixed at issuance. The focus of this session is on the marketable or negotiable Treasury debt, the debt that can be traded in the fixed income or capital markets. Though not an issue to be discussed in detail here, the session will introduce the non-marketable or non-negotiable Treasury securities to give some insight into the broader context. The marketable or negotiable debt is comprised of the bills, notes, and bonds issued to investors by the U.S. Treasury. The non-marketable or non-negotiable debt are savings bonds or securities issued to other elements of the U.S. government aside from the Federal Reserve. Savings bonds are U.S. government obligations purchased from the Treasury. Savings bonds are offered continuously directly by the Treasury. Often they are purchased by individuals through a payroll savings plan where an employee can have a portion of their pay invested in U.S. Treasury securities rather than paid out to them in cash. If held to maturity, the securities will be redeemed by the U.S. Treasury. If a holder decides to sell a savings bond prior to maturity, they can only be sold back to the U.S. Treasury. They cannot be sold to another investor. Although the mechanics of the sale often entail selling them at a conveniently located bank branch. The bank, however, is not buying for its own account, rather as agent for the U.S. Treasury. The other category of non-marketable or non-negotiable Treasury debt are the securities issued by the Treasury to other entities of the U.S. government. By law, most government agencies or entities that have surplus funds must invest that surplus in U.S. Treasury securities. An example would be the Social Security Trust Fund. So when a government entity has a surplus, it will exchange those monies for securities issued to them by the U.S. Treasury. Those securities are never subsequently sold to other investors. They're typically held to maturity. The government agency holding them will collect the interest periodically and at maturity receive the principal when the securities would be retired by the U.S. Treasury. Because these securities cannot be traded in the secondary markets, and in effect it's money the U.S. government owes to itself, these securities are not counted when calculating the size of the U.S. government securities market. An issue that many people new to the fixed income markets find confusing is the debt of the U.S. government versus the size of the U.S. Treasury market. In recent years, we've seen frequent battles between the Democrats and Republicans in Washington about raising the debt limit. Over the previous several years, it's been raised a few times from 16 plus trillion to 17 plus trillion to currently 18 plus trillion dollars. Yet, over the same time frame, the approximate size of the U.S. Treasury market has gone from 10 to 11 to approximately 12 plus trillion dollars. How does this square? It's related to the previous discussion about the negotiable versus the non-negotiable Treasury debt. The approximate size of the U.S. Treasury securities market as of the beginning of 2015 was about $12.5 trillion. That's the amount of bills, bonds, and notes in the hands of investors and the Federal Reserve System. Those are the instruments referred to earlier when discussing the marketable or negotiable Treasury securities. But total government indebtedness includes the non-marketable or non-negotiable debt, the savings bonds, and the Treasury securities issued to other government entities with surpluses that were cited earlier. Those non-marketable or non-negotiable instruments total to about $5.6 trillion. So if the $12.5 trillion of marketable debt is added to the $5.6 trillion of non-negotiable debt, the approximate total debt for the U.S. government is $18.1 trillion. Let's move on to an investigation of the individual types of Treasury securities. We'll start with T-bills. There are 4 standard maturities of new issue T-bills that are currently being auctioned with some regularity. They are usually referred to as 1-month T-bills, 3-month T-bills, 6-month T-bills, and 1-year T-bills. Realize those are names, not accurate descriptions of the actual time to maturity from issuance. Take the 3-month bills, for example. What's the length of 3 months? Of course, one would have to identify which 3 months before being able to determine the answer. 3 months cannot be a precise method for defining a time to maturity. What are commonly referred to as 1, 3, and 6-month bills do have a set specific time to maturity, but actual time to maturity is not reflected in the name. The 1-month T-bills actually have 4 weeks or 28 days to maturity from issuance. The 3-month bill is literally a 13-week or 91-day instrument. The 6-month bill has 26 weeks to maturity, and the 1-year bill actually matures 52 weeks after issuance, 1 day less than a full year. Each of the various maturity bills are auctioned off at set times, though not at the same frequencies. The bills that have the most regular auctions are the 3 and the 6 month bills. Both the 3 and the 6 month bills are auctioned every Monday. 1-year bills are auctioned about every fourth Tuesday. When the 1 month bills are issued, they're auctioned on Tuesdays. T-bills are a type of instrument referred to as discount securities. The pattern of cash flows to investors is quite different than with traditional fixed coupon bonds. Discount securities have no coupons. The only cash flow to the investor is the face amount at maturity. Let me illustrate T-bills, or discount securities more generally, with an example. Assume an investor was participating in one of the weekly auctions of 3-month or 13-week T-bills. The investor submits a bid for $10,000 face value of the 3-month bills. Based on the auction results, the issue price of those 13-week bills was going to be $9,973. The investor would have to pay that price on the following Thursday when the Monday auction settles. Assuming the bills are held to 13 weeks to maturity, 91 days after the auction settlement, the investor would receive the $10,000 face value. That would mean the investor's interest, or return for holding the bills to maturity, would be the difference between the $9,973 paid at issuance and the $10,000 received at maturity. In other words, the investor would have earned $27 of interest income. Assuming no default, it's the discount from face at which the bill is purchased that would be the interest income earned if held all the way to maturity. We'll move the discussion on to bonds and notes in just a few moments. But before we do so, let's talk about how Treasury securities are quoted. T-bonds and notes are normally quoted differently than T-bills. Bonds and notes are quoted in a fashion similar to the bond quotations discussed in the introductory modules of this program. They're quoted on a price basis, though using a different convention than is common in the corporate bond market. T-bonds and T-notes are quoted by percent of par, with the minimum price fluctuation normally being expressed in 30 of a percent. To illustrate, assume there is a Treasury bond or note trading at 98 and 24/32. That could be expressed as either 98-24 or 98:24 or 98.24. Note how the divisor in the fraction is not given. It's presumed that when one is looking at a Treasury quote, the number to the left of the separating symbol represents full percents of par, and the number to the right of the symbol represents 30 of another percent. Treasury security trades are typically larger than the average corporate or municipal bond trade, sometimes dramatically larger. Trades for tens or even hundreds of millions of dollars are not uncommon. Consequently, they are sometimes traded at price increments even smaller than a 30-second. A common method for expressing the next smallest increment is to attach a plus sign to a Treasury quote. The plus sign indicates an additional half of a 30-second. So our 98-24 would indicate 98 and 24/32. A price quote of 98-24 plus would be interpreted as 98 and 24.5/32, which of course is equivalent to 98 and 49/64. Where price quotes are the norm for expressing the value of T-bonds and notes, the convention for quoting T-bills is to do so on a rate basis. The interest rate used to express the value of T-bills is known as the discount rate. That's potentially confusing because the phrase discount rate has a number of different meanings depending upon the context in which it's used. In the context of a bill, a discount rate of, say, 1.76% is the Treasury market methodology for indicating the current value or price. Especially for those new to the fixed income markets, rate or yield quotes can seem an obtuse way of expressing value. Some market segments normally rely on price quotes, but others normally rely on rate quotes. Make no mistake, either method implies a specific dollar price. Though not addressed here, expressing value on a rate basis often makes it easier to make cross-security comparisons to get a clearer sense of how much an investor is paying today per dollar of future cash flow on different securities. This issue will be addressed in more detail in modules dealing with bond math. The U.S. Treasury issues two types of fixed coupon securities, Treasury bonds and Treasury notes. The two are extremely similar to one another. There is really only one primary difference between them, the time to maturity from issuance. Notes are defined as securities having anywhere from 1 to 10 years to maturity from issuance. Bonds as any Treasury security issue with an initial maturity of more than 10 years. By convention, once issued, a bond or note will carry that designation all the way until it matures. A 30-year bond issued 25 years ago would not be considered a T-note even though it now has less than 10 years to maturity. A Treasury security issued as a bond is considered a bond all the way until it matures, likewise for Treasury notes. It might seem like a distinction without a difference, but it matters. Just one example to make the point. To make delivery on a short position in 10-year T-note futures requires Treasury securities having between 6.5 and 10 years to maturity as of the delivery date, and that the securities were issued as Treasury notes. So even though a 30-year bond issued 22 years ago would now have an appropriate time to maturity as specified in the futures contract, it would not be eligible for delivery, not good for delivery in the language of the futures market, because the security had been issued as a bond. It would never be considered a note. Beyond those contractual differences in initial maturity and bond versus note categorization, bonds and notes are extremely similar to one another. Both pay semi-annual coupons, and both are normally quoted on a percent of par basis, with the minimum price fluctuation being expressed in 30 of a percent. Indeed, to most investors, equivalent maturity bonds and notes would be compared purely on the basis of their investment characteristics. Most investors comparing a 10-year T-note issued 3 years ago and a 30-year bond issued 23 years ago would not care one whit that one is a bond and the other a note. Most investors would prefer to buy the one trading at the best relative value, including consideration of yield, coupon, liquidity, etc., without much concern about their status as a bond or a note. Let's consider Treasury notes in detail. Recall the definition of Treasury notes. Treasury securities having anywhere from 1 to 10 years to maturity from the date of issuance. The specific maturities being issued vary over time. The maturities of regular fixed coupon T-notes being auctioned with some regularity by the U.S. Treasury as of the date of this recording in early 2015 are 2-year, 3-year, 5-year, 7-year, and 10-year T-notes. The different maturities are not auctioned at the same frequency. The 2, 3, 5, and 7-year notes are auctioned on a monthly basis. The 10-year notes are new issues only during the quarterly refundings, which occur every February, May, August, and November. However, the months of the quarterly refundings are not the only months when 10-year T-notes are being auctioned on behalf of the U.S. Treasury. Those are the only months when the 10-year notes are being sold as new issues. However, the U.S.'s borrowing needs are so great that 10-year T-notes are sold in the off months as well. But when a 10-year note is auctioned in any month outside of a quarterly refunding, the security being sold is not an issue. That is, it is not an issue different than those already in existence and trading in the markets. Sales of 10-year T-notes outside of a quarterly refunding is a reopening of an existing issue. The Treasury will be selling more of the most recently issued 10-year T-note, which is referred to as the on-the-run 10-year. To illustrate, assume it's April, and the Treasury announces an auction of 10-year T-notes. April falls between the February and May quarterly refundings. The 10-year T-note the Treasury is selling during April would not actually have 10 years to maturity, only about 9 years and 10 months. 10-year T-notes being sold in April would be a reopening of the February issue. The buyers in the April auction would be acquiring securities maturing in February, 9 years and 10 months after the April sale, carrying the same coupon rate as the 10-year notes issued in the previous February. Next up, Treasury bonds. Recall their definition. Treasury securities having a time to maturity at issuance of anything over 10 years. The only maturity of regular T-bonds issued by the U.S. Treasury since at least the late 1960s is a 30-year T-bond. far enough back in history, other bond maturities were issued. And more recently, some inflation-protected T-bonds, known as TIPS, have been sold with 20-year maturities. But the only maturity regular bond the Treasury has sold in many decades is a 30-year. As with other Treasury securities, bonds are auctioned on a regular cycle. Like the 10-year T-note, the 30-year bond is sold as a new issue as part of the quarterly refundings. So 30-year bonds are only new issues when sold in February, May, August, and November. Also like the 10-year T-note, 30-year bonds are sometimes reopened for sale in the off months. A 30-year bond being sold in a month other than February, May, August, or November is a reopening of the on-the-run issue. What's being called a 30-year bond in an off-month auction is actually a bond with either 29 years and 11 months or 29 years and 10 months to maturity. I do not intend to linger over this chart. It's just a condensed summarization of the main distinguishing features of Treasury bills, notes, and bonds regarding their maturities, the way they pay interest, and the way they're quoted. Those of you wanting to reinforce those details can pause the video to review the summary. The only marketable or negotiable debt issued by the U.S. Treasury are bills, notes, or bonds. However, there are certain issues of bonds or notes that have special features. The first of those securities we'll discuss are known as TIPS. TIPS is an acronym for Treasury Inflation Protected Securities. They are also sometimes referred to as inflation-indexed Treasury securities. The most obvious difference between regular T-bond or note issues versus the same maturity TIPS are the significantly lower coupon rates on the TIPS. At the time of this recording, early 2015, comparing on-the-run regular 10-year T-notes to the 10-year TIPS, the respective coupon rates are 1 3/4% and 1/4%. But those coupons are not directly comparable. The regular T-note coupon is for a fixed dollar amount. The TIPS pays the investor not a constant dollar amount, rather the investor would get a number of dollars that represent constant purchasing power. TIPS are said to pay investors a real coupon, real in the sense that the dollar amount of the coupon payments would be adjusted for changes in the price level. So the dollars received each period by the investor would represent the same purchasing power as money invested at issuance. The coupon itself is fixed, but that constant coupon is paid on an adjusted face amount. Individual coupon payments will be the coupon rate set at issuance times the initial par value adjusted for changes in the price level since issuance. Price level changes, usually thought of as inflation, are measured by the Consumer Price Index, oftentimes referred to by its acronym CPI. Coupon payments could be adjusted up or down, up for inflation, down for deflation. Naturally, as inflation means a rise in the price level, it would require a larger coupon payment to offset the impact of higher prices. Conversely, the coupon payments would be adjusted downward in a period of deflation, deflation being negative inflation or falling prices. Less money could have the same purchasing power in a lower price environment. Though coupons can be adjusted either up or down for inflation or deflation respectively, deflation would never result in an investor receiving anything less than 100% of par at maturity. So at least in terms of the maturity value, investors are protected both from inflation and deflation. To illustrate how TIPS work, let's consider the cash flows on otherwise similar regular T-notes and TIPS. Assume there are two $100,000 par value securities, both having 10 years to maturity. The 10-year T-note has a 2% coupon, the TIPS a 1/4% coupon. The example will look at the first two coupon payments as well as the maturity proceeds to the security holders, assuming 3% total inflation over the first coupon period, 5% total inflation over the second coupon period, and cumulative inflation of 35% over the 10 years to maturity. For the 10-year T-note, absent a default by the U.S. Treasury, each of the 20 semiannual coupon payments over the 10 years to maturity will be for exactly the same dollar amount. Each coupon payment would be based on the $100,000 par value times the 2% coupon rate times 0.5 to reflect the fact that each coupon is for exactly 1/2 of the year's interest. All of the semiannual coupons will be for $1,000. The final coupon at maturity would be accompanied by a return of the $100,000 par value. The holder of the 10-year TIPS will receive coupon payments that vary over time since the price level is changing. The coupon payments on the TIPS will be based on the adjusted face amount, which is determined by multiplying the original face by the TIPS inflation index ratio that quantifies cumulative inflation as measured by the consumer price index between issuance and the date of the coupon payment. The coupon payments will be calculated from the adjusted face times the coupon rate times 0.5 to reflect the semi-annual frequency of the coupons. What's the consequence for the first coupon if the inflation as measured by the consumer price index was 3% during the period? The adjusted face amount would be calculated by multiplying the $100,000 original face times 1.03, 1 plus total inflation, times 0.0025, the 1/4% coupon expressed in decimals, times 0.5 to reflect each coupon being for 1/2 of the year's interest. So the first coupon payment would be for $128.75. The process is generally the same each period. The example assumes total inflation in the second coupon period of 5%. The TIPS inflation index ratio can be computed by chain linking the individual period inflation. The TIPS inflation index ratio for the second coupon would be 1.0815. That number is derived by multiplying 1 plus the first period's inflation times 1 plus the second period's inflation, or 1.03 times 1.05. So the second coupon amount would be computed by multiplying the adjusted face amount of $108,150 times the 0.0025 coupon rate times 0.5 for the half year, equaling $135.19. The final adjustment at maturity would be used not only for determining the coupon payment, but also the maturity value of the principal. Given inflation over the 10 years at 35%, the TIPS inflation index would be 1.35, resulting in an adjusted face amount of $135,000, the $100,000 original face times 1.35, and a final coupon of $168.75, the $135,000 adjusted face times 0.0025 for the coupon rate times 0.5 for the semi-annual frequency. The total cash flow to the TIPS investor at maturity would be $135,168.75. The most recent addition to the menu of U.S. Treasury offerings are Treasury floating rate notes, or FRNs, FRN being a common abbreviation in the fixed income markets for floating rate notes. The U.S. Treasury issued FRNs for the first time only in early 2014. At present, the only maturity floating rate note is a 2-year security. Unlike other Treasury coupon issues, the coupons on floating rate notes are paid quarterly, which is not the norm for U.S. Treasury coupon securities, though that frequency is very common on corporate floating rate notes in the U.S. market. By Treasury rules, coupons theoretically reset daily. However, the mechanics of the reset are based on the most recent auction of 3-month T-bills. Since 3-month T-bills are auctioned only once a week, the effective reset frequency is weekly. The floating rate note coupon is based on the highest accepted yield from the most recent 3-month bill auction. The floating rate note coupon is not set at that highest accepted yield. Rather, it's the highest accepted yield adjusted by the spread that was established at the original auction of the floating rate notes. That spread could be either positive or negative. Treasury floating rate notes are issued on a quarterly basis, though not as part of the quarterly refunding. Floating rate notes are auctioned as new issues every January, April, July, and October. Like other Treasury issues, floating rate note issues can be reopened in the off months. So issues during the other 8 months of the year would be a reopening of the most recent new issue of floating rate notes. The presentation has addressed in some detail all of the negotiable securities issued by the U.S. Treasury. However, there is another security that represents a claim on the U.S. Treasury that trades in the markets, though these securities are not issued by the U.S. Treasury in the form in which they are traded. It's a security known as Treasury Strips, sometimes referred to as zero-coupon treasuries. Strips is an acronym that stands for Separately Traded and Registered Interest and Principal Securities. From an investor's perspective, they work just like zero-coupon bonds, but these strips are not issued by the U.S. Treasury in that form. Strips are created by investors. When an investor buys a Treasury bond or note, they are acquiring a package of cash flows, some number of semi-annual coupons, and the principal at maturity along with the final coupon. The holder could sell the whole package of cash flows to some other investor. That is, the holding investor could sell the security as a bond or note, the form in which it was originally purchased. Alternatively, the investor could strip or separate the cash flows and sell each cash flow to a different investor. The individual coupons and principal payments will then trade separately as Treasury strips. That abstract description might be hard to follow if you're not already familiar with these securities, so a simple example might help to clarify things. How are Treasury strips created? Assume an investor buys a $10 million par value 2-year T-note that has a 4% coupon at one of the monthly auctions. The cash flows to the holder of that 2-year T-note would be a series of 4 semi-annual coupons of $200,000 each, and the $10 million par value paid simultaneously with the final coupon. The first coupon would be due after 6 months, the second coupon after 12 months, the third coupon after 18 months, the fourth coupon in principal at the end of 24 months. That is the package of cash flows acquired by the buyer of the 2-year T-note. Though the monies are due on 4 dates, it will be viewed as 5 cash flows, as the final payment has 2 components, the final coupon as well as the principal. If one sells the entire package of cash flows to an individual investor, the cash flows are still trading jointly as a 2-year T-note. Strips would only be created if the cash flows were sold separately. Assume the following is occurring on the day of issuance with the security having exactly 2 years to maturity. The original purchaser of the 2-year T-note sells the first $200,000 coupon to investor A. The first coupon becomes a 6-month Treasury strip with a face value of $200,000 labeled CI for coupon interest. The second coupon is sold to investor B. That coupon becomes a 12-month $200,000 face value coupon interest strip. The third coupon is sold to investor C, which is now an 18-month $200,000 face value coupon interest strip. The cash flows at maturity would be sold as 2 separate strips. The coupons sold to investor D, creating a 24-month $200,000 face value coupon interest strip, and the face value would be sold to investor E, creating a 24-month $10 million face value note principal strip. That's the process through which Treasury strips are created. A number of times earlier in this module, there have been references to the original sale or issuance of Treasury securities. Without describing the process in detail, the sales were referred to as auctions. Let's now take a closer look at the mechanics of that process. The initial issuance of Treasury securities is done in a fashion quite different from the typical corporate or municipal debt offering. Most corporate, municipal, and even government agency issues are accomplished with the assistance of an underwriting syndicate. The specific process is more involved, but in substance the underwriters, a group of banks and broker-dealers, are selling the securities on behalf of the issuers. The U.S. Treasury sells so many securities so often that all that needs be done is for the Treasury to announce the intention to sell securities, and numerous investors stand ready to buy. In fact, there are usually so many bids submitted that there are normally somewhere between $2.50 to $3.50 worth of bids for every $1 of securities being offered. The pricing of Treasury issues is also quite unlike the typical corporate or municipal bond sale, which is usually done for a fixed price at a set yield. For Treasury securities, the yield at which investors will buy the newly issued securities is not known at the time of the offering. The yield will be determined through the offering process itself, causing Treasury security offerings to be referred to as yield auctions. The yield will be determined via a competitive bidding process involving a majority of the participating investors. Various competitive bidders are submitting bids reflecting a variety of different prices that they would be willing to pay. However, the offerings are structured as a single price auction, also known as a Dutch auction, which means that all of the accepted bids will be filled at the same price. Both competitive and non-competitive bids can be submitted. Non-competitive bids are only allowed for bidders submitting bids for less than $5 million. Individual investors submitting multiple bids or groups of investors acting in concert would have to accumulate the total value of all their bids when assessing the eligibility to submit non-competitive bids. Bidders for $5 million or more can only submit competitive bids. Competitive bids must indicate both the par amount of securities the bidder wants to purchase as well as the highest price they would be willing to pay, though that price is expressed in the form of the lowest yield they would be willing to accept. Non-competitive bids need only state the par amount to be purchased. To get a better understanding of Treasury auctions, first an overview of the process, then a walkthrough of a sample Treasury yield auction. The process starts several days in advance of the auction taking place when the Treasury announces the size and maturity of the offering, in other words, the par value of the securities to be issued and the date upon which the securities will mature. For example, the Treasury might announce it's selling $22.5 billion of 2-year T-notes, or perhaps $7.5 billion of 30-year bonds. Bids from interested parties need to be submitted by a specified time early on the day of the auction. The bids are submitted to the Federal Reserve, which conducts the auction on behalf of the Treasury. All bids received in a timely fashion will be reviewed. Enough of the offering will be set aside to fill all of the non-competitive bids. The remaining securities will be allocated to the competitive bidders that had submitted the best bids. All of the orders at the lowest yields are filled first. If there are still securities remaining, all of the bids at the next lowest yield will be filled, and so on until all the securities have been allocated. Orders submitted at the highest accepted yield will be allocated on a pro rata basis. Although the securities are allocated on the basis of the best competitive bids, Treasury sales are structured as single price auctions. Once all of the winning competitive bids have been identified, the Fed will compute the average price of the accepted bids, then all of the non-competitive and the accepted competitive bids will be filled at the average accepted price. A sample Treasury auction. Say the Treasury announces the intention to sell several days hence $12 billion of 13-week bills. By the deadline on the morning of the auction, let's say the Federal Reserve has received $28 billion of competitive bids and $2 billion of non-competitive bids. Of the $12 billion issue, the Fed will set aside $2 of the $12 billion so as to be able to fill all of the non-competitive bids. The remaining $10 billion of bills will be allocated to the competitive bidders that have submitted the best bids. The lowest yield bids filled first, the next lowest yield bids filled second, etc., until all of the $10 billion available to the competitive bidders have been allocated. Let's dig a little bit deeper into the mechanics of a Treasury yield auction. Assume we have bidders A through H that have submitted competitive bids in a timely fashion. The yields submitted by those bidders are shown on the left-hand side of the exhibit. Bidder E has submitted the lowest yield bid, which means E was willing to pay the highest price. The par amount of securities to fill E's order are subtracted from the securities available to the competitive bidders. Bidder C has submitted the next best bid, second lowest yield, second highest price. So the par amount to fill C's order are set aside, and so on. The implication to be drawn from the right-hand side of the exhibit is that investor D's bid is the highest yield, lowest price bid to be filled. That yield price is referred to as the stop out. If there are multiple bids at the stop out that aggregate to more than the remaining securities, all bids at the stop out will receive a proportional fill. All the bids at lower yields, higher prices are filled in their entirety. All the bidders at higher yields, lower prices go unfilled. Despite the method for deciding which orders are to be filled being based on the bid yield submitted, all accepted orders are filled at the average price of the accepted competitive bids. That's true of both the accepted competitive bids as well as the non-competitive bids. Some yield auction metrics and related concerns. One of the statistics used when assessing the success of a Treasury yield auction is the bid-to-cover ratio. That ratio is computed by dividing the total amount of securities being bid for by competitive and non-competitive bidders by the amount of securities being offered by the Treasury. In this example, there were $30 billion worth of bids submitted, $28 billion of competitive and $2 billion of non-competitive, to buy $12 billion of securities being offered. The bid to cover in this example would be 2.5 times. That would be a relatively low bid to cover based on Treasury auctions over the past few years. In general, the higher the bid to cover, the more positive the assessment of the auction's outcome. The stop out was mentioned previously. It's the lowest priced, really highest yield, bid at which competitive bidders will have securities allocated to their orders. It's unlikely the amount of securities bid for at that rate or price will match exactly the securities remaining to be allocated to competitive bidders. Bids at the stop out receive a proportional fill. For example, if there were $5 billion worth of bids at the stop out, but only $3 billion of securities left to allocate, all of the orders at the stop out would get 60% of the par amount indicated in those bids. As this example was based on a 3-month bill auction, that stop out, the highest accepted yield, becomes the basis for the coupon reset of Treasury floating rate notes. The final portion of this module will be an overview of the U.S. government agency securities market. Most investors would consider the majority of agency securities as near substitutes for U.S. Treasury securities, and with good reason. With some exceptions that will be noted later, the investment characteristics of agencies in terms of their contract features, expected returns, and risks are very similar to those of equivalent Treasury securities. In a sense, agencies are as safe as Treasuries or the next best thing regarding credit risk exposure and offer slightly better expected returns. Though much smaller than the government, corporate, or mortgage-backed markets, the agency market is a significant sector in its own right. About $2 trillion worth of securities outstanding as of early 2015. The market is comprised primarily of debt issued by a relatively small number of entities. Less than a dozen account for the vast majority of the outstanding agency securities. Average issue sizes are relatively large. That and the safety lead to good liquidity. All agency securities are considered to be of extremely high credit quality. Some agency debt is government guaranteed, backed by the full faith and credit of the U.S. government, same as with Treasury securities. By law, de jure and legalese, the government is obligated to meet the debt payments of these agency securities. Some agencies' debt is not guaranteed by the U.S. government. These securities are legally backed only by the issuing agency's revenues. However, market participants generally believe that there is an implicit, that is de facto, in fact, if not in law, guarantee. It's a belief justified by history so far, as over the past few decades the U.S. government has bailed out the Farm Credit System in the early 80s, the Federal Home Loan Bank System in the late 80s, then Fannie Mae and Freddie Mac in the aftermath of the financial crisis of 2008. Comparing same maturity similar securities, for example 6-month T-bills to 6-month discount notes, or 10-year T-notes to 10-year non-callable agency securities, the agency securities trade at a slightly higher yield and have slightly higher expected returns. Given the minimal default risk, many believe that for similar securities, it's the lesser liquidity of agencies compared to treasuries that account for most of the difference in yields. Which is not to say agency securities are illiquid. They're just less liquid than treasury securities, although better liquidity than with regard to high-quality corporate securities. Most of the types of securities in the agency market are very similar to the Treasury securities discussed earlier. Discount securities, fixed and floating rate bonds. Some agency securities have features not encountered with treasuries. Some agency securities are callable and some have structured payouts. There are two categories of entities that issue what are referred to as agency securities: government agencies and government-sponsored enterprises, often referred to by the acronym GSEs. Government agencies are part of the government, performing their directed activities on the government's behalf. As such, debt of these government agencies is guaranteed by the federal government. Government-sponsored enterprises are considered private entities. The creation of these private entities was sponsored by the government, usually to direct additional financing into favored types of economic activities, such as housing, rural electrification, or agriculture. The specific ownership structure varies across the different GSEs. Some are investor-owned, some are member-owned cooperatives, one is even owned by the federal government itself. Debt of the GSEs is backed only by the issuing entity's revenues, not by the federal government. Some examples of agencies whose debt has a government guarantee: the Government National Mortgage Association, also known as Ginnie Mae, the Export-Import Bank, the Federal Housing Administration, and the Small Business Administration. Examples of GSEs: investor-owned, at least in theory, would be the Federal National Mortgage Association and the Federal Home Loan Mortgage Corporation, more colloquially known as Fannie Mae and Freddie Mac. I say in theory because at present those two mortgage agencies are under a government conservatorship. The two will likely be privatized again, although there is no clear roadmap to that end state at present. Member-owned cooperatives, the Farm Credit System, and the Federal Home Loan Bank System. Member institutions buy stock in these GSEs, which typically makes accessible certain types of attractive financing. The member-owned shares cannot be traded or transferred. The Tennessee Valley Authority is a government-owned corporation, but the TVA is not a government agency. It's a separate legal entity. The TVA's debt is not backed by the federal government, only by the TVA's own revenues. The majority of agency securities have structures that are very similar to the Treasury bills, notes, and bonds discussed earlier. A common type of agency security issued by most agencies are discount notes, or as they are sometimes called, DISCOs. These are discount securities that work just like T-bills. Discount notes are issued at a price below par, in other words, at a discount to their face value. The only cash flow to the holder is the face amount at maturity. So the discount from face at which the discount note was purchased would be the investor's income if the DISCO is held to maturity. Also like bills, DISCOs are short maturity securities. A year is the maximum maturity, though most are significantly shorter, typically 3 months or less. Also like treasuries, agencies issue both fixed and floating rate coupon securities. The bulk of agency long-term funding is through issuance of fixed coupon bonds. Like most U.S. issued bonds, agency bonds have semi-annual coupons. Most maturities are between 1 and 10 years, though some will have maturities out to 30 years. Unlike treasuries, agency securities use the 30-360 corporate day count convention. Also unlike treasuries, some agency bonds are callable. The implications of those call provisions will be addressed in a few minutes when we're discussing the unique features of agency securities versus those found in treasuries. Agencies issue floating rate notes also, though agency floaters exhibit quite a variety of features compared to the single 2-year floating rate note issued by the U.S. Treasury. There is a much wider range of maturities, most between 1 and 10 years, though they can be significantly longer term. Similarly, there is lots of variation regarding coupon resets. Agency floating rate coupons will be based on a variety of different index rates, as well as having a variety of different reset frequencies. Most outstanding agency securities have features very similar to Treasury securities, as was just discussed. However, a subset of agency securities have contract features not currently seen in the U.S. Treasury market. A portion of the long-dated securities have embedded call options, and a few have structured payouts. The existence of a provision for early retirement will cause a significant divergence of price performance in a falling interest rate environment between callable and non-callable securities. A call provision places an effective ceiling on price as market rates fall below the coupon rate of the bond. A callable bond is not likely to trade much above the call price if a bond is currently callable or becomes so in the near future. The compensation to investors is that callable bonds will offer higher coupons than otherwise similar non-callable bonds. Also, if callable at the issuer's option, the investor will usually receive a premium to par on any early retirement. For most callable agency debt, the call is at the issuer's option. However, in some cases, the call could only occur on the happening of some event. An example would be some debt issued by Fannie Mae or Freddie Mac that could only be retired early if mortgage prepayment rates exceeded specified levels. Some agency debt falls into a category called structured notes. The payout to the holder is not a simple fixed or floating rate of interest. The payout is structured. A simple example is a stepped coupon structure. The bond has fixed coupons, but not all are paying the same rate of interest. The coupon rate increases at a set specified schedule over time. This offers the investors some protection from rising interest rates, but also increases the exposure to call risk. Some structured notes have payouts tied to factors such as equity indexes or currency exchange rates, among other things. The agency itself is paying a fixed or floating rate of interest, but the return to the investor is attached to some other exposure. There is some sort of derivative built into the structure that limits the agency's exposure to the fixed or floating rate of interest it's paying to a derivatives dealer, while providing the appropriate return to the investor.